Hi, Mark Oswald again, your host for Londonderry Heart, Home, and Soul. Our continuing series on home purchase, home buying process. And now that you've received a grounding or an introduction into credit, we're going to talk about actual mortgage products that are out there. So coming back for more is JJ Sawicki, who is an Assistant Vice President with Merrimack Mortgage. Welcome back.
Thank you.
And Nelie Doughty, who is your local loan officer with Merrimack Mortgage. Thank you, ladies.
Thank you.
So sometimes a lot of confusion around FHA and VA and conventional and adjustable rate.
Yep.
So why don't you clarify that for all of us?
Okay. So there are multiple different mortgage programs that are available to consumers. Basically, the way that I view mortgage programs are basically like cereal, right? One cereal might be cheaper or better for for a particular family than another. So let's just talk about the different mortgage programs that are available. So you have your conventional mortgage programs, which are Fannie Freddie programs. Those are government-sponsored agencies, okay? We've got FHA, which is through the Federal Housing Administration, VA, which is really just for veterans, and then you've got RD, which is rural development. So kind of the differences between some of these products is, we'll start out with FHA first. FHA will allow financing up to 96.5%, where a potential home buyer will put just 3.5% down. And under FHA, it doesn't necessarily have to be their own funds. They can get a gift for the entire down payment, which is really nice under that program. They also allow for up to 6% seller contributions on that program, which is very high at that loan to value, which is nice. There is a upfront an upfront funding fee that is required on that program, and that's typically rolled into the loan amount. It's based on a percentage of the loan amount. They do also have to pay a small mortgage insurance premium on those programs, and that premium never goes away, so it's for the life of the loan. Mm-hmm. But I think that under FHA scares people a little bit just because you say it's for the life of the loan. But really you have to consider the fact that an average mortgage has a lifespan of about 7 years, so it's really not that long. It's not going to be for 30 years unless you keep your mortgage for 30 years and never refinance, okay? Another program that we have is rural development. Rural development is probably one of my favorite programs personally. That will allow up to 100% financing. The seller contributions are unlimited, which is really, really nice. So literally a borrower can walk into closing and bring no money whatsoever at 100% financing, none of their own funds. That does require a guarantee fee, which is a percentage of the loan amount, and that can be rolled into the loan amount, and that's over and above the 100% financing, which also is nice. They also require a monthly MI premium, and that will vary based on whether the loan is a purchase or a refinance. They do a nice RD to RD refinance program. There's also the VA program, which is out there. VA will allow up to 100% financing as well. They have no monthly mortgage insurance. There is a funding fee on that program as well, which again is based on a percentage of the loan amount. That program will allow up to 4% in seller contributions. So, and then you kind of go back to your regular conventional programs, which are really the most typical programs that are out there. And those are the ones that are offered by Fannie Mae and Freddie Mac. On those programs, the lowest down payment available is 3%, typically 5%, depending on whatever program that you're doing. These conventional programs have multiple different options to them, so you definitely would want to talk to your lender to find out what conventional option would suit you best. Depending on the amount of down payment and the loan purpose, whether it be you're buying it as a primary residence, a second home, or an investment, the seller contributions will vary on those programs. And the conventional programs, the credit criteria, the qualifying criteria, is it's pretty tight. Really, the minimum FICO is a 620, but FICO isn't always a great representation of your credit history. So there are other programs out there, again, like FHA, VA, and RD, where the credit qualifying criteria is it's much more flexible. So you might find that you qualify under a max financing FHA loan when you didn't necessarily qualify for a conventional loan with 20% down.
And where does PMI fall into those programs?
So when it comes to PMI, really if you're putting less than 20% down, then you would have to pay a monthly MI premium.
Okay. And you mentioned seller concessions throughout. So I only want to
And
caution
force.
our viewers that that's at the agreed upon amount or percentage of the seller. So
Correct.
if you're a buyer and you're making an offer on a property, you're asking for a concession to pay presumably prepaids, closing costs,
Yes.
and the like. The seller's not under any obligation to do so.
Absolutely not. No?
So, and as we now find ourselves in the seller market, there's probably less likelihood
Yeah.
of that occurring.
Yes.
So I just want to make sure viewers are clear on that. When we were in a buyer's market, 4 and 5 years ago, that was pretty standard practice.
Yeah, that would have to be an agreed upon term, and that would have to be written into your purchase and sales agreement.
And it's
Because
also something that as a partner, a loan officer working with a real estate agent or with the clients, saying, realizing which programs will work best, and with permission from the borrower, sharing that with the realtor, saying, this product is actually better for them, however they would need or would benefit greatly by a small seller concession, or it could make the difference in a big difference in their qualifying or not qualifying,
Yeah.
because some programs do require that there are reserves at the end of the loan, not money that they have to bring, but money they have to show in an account. And so like it's been said, they don't want to deplete every dime that they have.
Right.
A lot of the programs have built-in safeguards for that, making sure that they don't deplete everything that they have. And so because of that, a seller concession would be beneficial.
I find a very critical role for a buyer agent is expectation management.
Yes,
Yes.
that's correct.
So when it
Yeah.
comes to seller concessions, I think we have
Yeah.
to walk carefully.
Yeah.
Well, a lot of the programs, as JJ was just saying, because they are such low down payment, there are gift funds, potential seller concessions that we'll tiptoe carefully around. But right now, this time of year, I just want to point out that many of these young couples, the millennials, are receiving tax returns, tax refunds back.
Yep.
Right.
And a lot of times that's enough money to get them into a home, and they just don't realize it. So it's
That's
a
true.
great, it's not a fortune with some of these great products. And while yes, they don't have 20% saved to avoid mortgage insurance, it's still, it's getting them into a home, and it's getting them their interest tax deduction, and it's the American dream. They have that opportunity because of mortgage insurance and because of PMI.
Yep.
And now's a good time.
Right.
Absolutely.
Timing is everything.
Yes,
Be ready for the spring market.
that's right. Yep.
Yeah. be
Looking
ready.
forward to it.
Final thoughts?
I guess there's just a couple more things that I wanted to add, kind of piggybacking off of what Nelie said. We've got a lot of millennials coming into the marketplace now that are looking to, buy homes. Maybe they don't necessarily have that much saved. It's showing now that more and more millennials are not necessarily using traditional credit. They're buying a lot of things with cash. So even if you have a low down payment, you don't have that traditional credit, but you have non-traditional credit, it doesn't mean that you can't get financing. There's quite a few programs that are available out there for you.
Good point. Good point.
There's even a new one that allows border income, but
Border income and non-household,
Yep.
non-borrower household
Yep.
income.
that's
Terrific.
enough. Sorry,
Yep,
I'll hush now.
there's all kinds.
It's very exciting.
Thank you again.
Thank you very
Thank
much.
We'll have you back.
Thank you.
Thanks.
And thank you for watching. Remember, as always, be of good heart.